Hi, I'm Matt Smith, and this is Spark Spread. Last week, Tesla released its Q4 2020 results, and by most accounts, it was a miss, at least on earnings. But there were several interesting tidbits in their financial disclosures, and in particular on their earnings call, that I think are worth a deeper dive. So let's take a minute here in this video to unpack some of the things that I thought were particularly interesting. Elon started off the call with comments on Tesla's valuation, and for once he was not saying that it was too high. So I thought that was a really nice change of pace, and he actually laid out a framework to justify Tesla's current share price. Tesla's market cap right now is just over $800 billion or so, and Elon laid out a case for a $1 trillion valuation today. So let's walk through some of the math that he laid out there so that we can understand what he's trying to say. Elon started off with a $50 to $60 billion automotive revenue top line target. So let's call it $50 billion in automotive revenue, which is roughly 1 million units at an average sale price of $50,000. So that's pretty close to what they're going to be doing in 2021. Maybe 2022 they'll hit 1 million vehicles, although I think they'll be higher by then. But somewhere in the 2021 to 2022 timeframe, they'll be at 1 million vehicles. Then at that $50,000 average sale price, you've got $50 billion in top line automotive revenue. Elon then says that in an autonomous future, those vehicles will have around 5 times more utility than they currently do today. But for purposes of this valuation that he's laying out, he only uses 2 times. So we take the $50 billion in revenue that he's laid out there and multiply that by 2 to account for future revenue that Tesla will be able to generate in this autonomous future. Elon then points out that this incremental $50 billion in revenue will be from software sales. So it will be almost entirely pure margin from Tesla, meaning that it will drop to the bottom line. So now we have $50 billion in earnings from Tesla, which is a huge step up from where they are today. He then applies a PE multiplier, or price to earnings ratio, of 20 on that $50 billion of earnings to justify a $1 trillion valuation for Tesla. So I think this is a really great kind of framework that Elon has laid out. I would point out it's not really a proper valuation as a financial professional would put it out. It's more of a generic framework, so I do have a couple kind of technical nitpicks on it from that point of view. But really, I think what he was trying to lay out was kind of back of the envelope napkin math on how we can get to justify Tesla's current share price. But if we do accept his premise here, I do still take issue with some of his individual assumptions, mainly that I think they are too conservative. So let's walk through these assumptions one by one. For starters, the $50 billion revenue line implies 1 million cars at an average selling price of $50,000. If Tesla is growing at 50% per year, then a better method might be to look at 2025 deliveries of, say, 2.5 million units. Even at a lower ASP of $40,000, that's $100 billion of revenue, or $200 billion if we assume 2 times the utility, as Elon does. This gives us earnings of $100 billion, or at a 20 PE, that equates to a valuation of $2 trillion. Discounting that back to today, at a 10% cost of equity, would imply a value of $1.4 trillion. Meaningfully higher than the $1 trillion that Elon put together. So my main issue here is that if you want to use Elon's methodology, really every assumption that he used is conservative. His beginning automotive revenues using 2021 rather than 2025 or even later, and then just discounting that back. The fact that he only assumed 2 times the utility of the vehicles rather than 5 times as he laid out the case for. And especially the PE ratio of only 20. If you look at all the other tech stocks out there like Apple and Netflix, Google, all these companies have PEs that are much higher than 20. So there's something a little incongruous about saying that you're going to be growing your top line by 50% per year and that it's going to be pure margin sales that are really going to drop to the bottom line, while at the same time saying that your PE ratio of next year's sales should only be 20 times. In my mind, that's just a little bit too conservative. So I think you need a slightly different methodology, or if you are going to use this methodology, use a higher PE ratio. Overall, I'm definitely happy that Elon has changed his tune and is kind of laying out a case to justify Tesla's current valuation, rather than making these comments that the share price is high, as he has done in the past. Overall, I think this is part of a string of recent comments by Elon that is expressing confidence in an autonomous future for Tesla. He's expressed confidence in the state of the technology, and now he's really kind of making the case that if you take that one step further, we can get to a $1 trillion valuation today just based on how close we are to achieving full autonomy and kind of the earnings results that will flow from that future. So definitely happy to see that comment from Elon to start off the earnings call. Now let's move on to automotive gross margin. This was a shock to me, and not in a good way. We had seen automotive gross margin improving throughout the course of 2020, reaching 27.7% in Q3. My expectation was with more made-in-China vehicles being delivered, as well as more Model Y and those kind of higher margin vehicles becoming a higher percentage of the overall mix, that we would see automotive gross margin increase once again in Q4. Additionally, with Tesla delivering a record number of vehicles in Q4, some of the fixed costs that the plants have, I figured would be amortized over a higher number of vehicles, leading to higher overall gross margin. Instead, what we saw is that Tesla posted its lowest automotive gross margin as a percentage of sales in Q4. They hit 24.1%, which was really not good. This is even lower than Q2 when the Fremont factory was shut down with the coronavirus concerns. So needless to say, this was not good news. Zach Kirkhorn explained what was going on. I'll quote him here directly now. He says, quote, "Automotive gross margin in Q4 was primarily impacted by two things. First, we invested in improving our products built in Fremont, including converting over to the new Model S and Model X, launching the single-piece castings on Model Y, and introducing heat pump on Model 3. Second, logistics and labor costs were impacted due to supply chain instability and pandemic inefficiencies. Adjusting for items such as these, as we do in our internal management views, we saw an improvement in auto gross margin." End quote. Later on, he says, quote, "We're working extremely hard to manage through the global semiconductor shortage, as well as port capacity, which may have a temporary impact." End quote. Zach does really give a lot of extra commentary here on some of the items that were specifically impacting Tesla in Q4. So putting these explanations together, it does seem clear that Tesla is experiencing some higher costs, which are impacting their gross margins. They also have some logistics issues. Hopefully those will get sorted out as they have more localized production, especially in Europe, to get around some of these port issues that they've been experiencing. I do expect some of these issues will probably carry over into Q1, however. The global semiconductor shortage is not over yet, so I would expect Tesla's probably incurring some higher costs into the beginning of 2021 at least. It'll certainly be something we want to keep an eye on. The last item I wanted to talk about was the take rate for full self-driving in China. They disclosed that was around 1 or 2%, which is frankly much lower than I had been expecting. So if you think about maybe a 25% take rate on full self-driving for vehicles in the United States, at $10,000, that equates to gross margin of around $2,500 per car on average. Potentially some of the pure manufacturing gross margin advantage that Tesla has in China might be eroded a little bit by the fact that you don't have that kind of $2,500 pickup on the software side in Chinese sales. So that potentially is causing a little bit of margin pressure as well as the Chinese deliveries become a bigger percentage of the overall mix. So where I had been expecting that greater deliveries of made-in-China Model Y and Model 3 would be a big bolster to overall automotive gross margin, that just may not be the case until the full self-driving take rate increases there as well. So something to continue to keep an eye on. So that's it on automotive gross margin. Definitely warrants keeping a close eye on this year, especially in Q1 and Q2. But now let's talk about energy gross margin. So historically, this has been very low, low single digits or so. In Q4, that actually went negative, despite the top line growing quite substantially. Personally, I'm not really that worried about this. Tesla's strategy here has been to cut costs to become the lowest cost solar provider, and really to try to make the hardware sales as attractive as possible. Right now, they're kind of at the beginning of ramping this S-curve. They want to get to 1.5 terawatt hours per year on the energy side by 2030. They're nowhere near that right now. So in my mind, it's way too early in the production ramp to be thinking about profitability on this side of the business. It'd be like going back to 2012 and the Model S launch and saying, oh yeah, that the company should be producing, a 25% gross margin on these vehicles. Well, not when you're ramping. So in my mind, I'm not too concerned about this. Something to keep an eye on, but the fact that it went negative here in Q4 when price cuts were going on, when they're hiring installation teams, they're really trying to figure out how to scale production of Solar Roof and installation of it and how to streamline that. So I'm much more focused and concerned about how quickly they can ramp, how much they can cut the installation time of solar roof down. And those are the sort of things that I'll be watching more closely rather than, was their gross margin 7% or 8% this quarter. The other thing I wanted to highlight on the energy side was just how quickly their deployments have been growing. So if you look at their actual results in Q1, and this is easy to get lost in the noise of all the other financial disclosures that are happening each quarter, but in Q1 2020, they deployed just over 200 megawatt hours of stationary storage. In Q2, that almost doubled. In Q3, that almost doubled again. And in Q4, that almost doubled again. So they're at just about 1,600 gigawatt hours deployed in Q4, which is just crazy. I mean, they're essentially 8x in Q4 what they did just in Q1. So this growth rate is insane. And in my mind, that's much more important than what their gross margin is on these products, as they are just at the beginning of this S-curve. So that's it on the energy side. A couple other points I wanted to touch on briefly here. One was on stock-based compensation. This is a non-cash expense primarily related to Elon's CEO performance awards. Those increased again in Q4 to $633 million. That's up slightly from $543 million in Q3. Again, this is non-cash, and for adjusted earnings, it gets backed out. So not something to spend a lot of time looking at. This will gradually come down over time as they're not accelerating so many of the tranches into a single quarter as they have been in Q3 and Q4. Might stick around for a little bit longer, but eventually this will go down close to zero. Interest expense also spiked in Q4, but that was really just related to early conversion of some of the convertible debt that was outstanding, not something to be overly concerned about. Tesla has said they're trying to pay down some of their outstanding debt, so interest expense will fall over time. And then guidance. This was something that Wall Street really dinged Tesla for on this Q4 call. I think a lot of people had been expecting Tesla to give specific guidance on deliveries for 2021. I think a lot of people had been expecting maybe 850, maybe 870,000 units delivered in 2021. Tesla didn't give a number, so they really got dinged in the press and in a lot of analyst eyes for not providing that guidance. But in my mind, this was a little misguided. What they actually said is that in the long term, they do believe that they'll continue to grow deliveries by 50% per year on average. Then Zach Kirkhorn said that in 2021, they may materially exceed that number. So if we're going off deliveries of 500,000 in 2020, 50% per year would be 750 in 2021. And Zach Kirkhorn is basically saying that they'll probably materially exceed 750,000. None of this is a surprise. On the Q3 call, Elon basically said that Pierre Ferragu's range of, I think it was something like 860 to 1 million units or so, was kind of what he was imputing based on the installed capacity. Elon said, yeah, that was about right. I mean, I think in my mind, they might have disclosed 850, but I think they're probably targeting internally maybe 1 million units or so in 2021. Now, they may land short of that. They may land, at 900,000 or so. But in my mind, this is just completely a non-issue. Their guidance has been the same. If you look at just their installed capacity base right now, they're already in position to deliver over 1 million units. They probably won't do that this year. But I don't think it was fair for Wall Street to ding them on guidance when, like they said, it's just hard to tell exactly how quickly you'll move up that S-curve as new production ramps. And then lastly, I want to touch on full self-driving. So a couple points here. One was just that they did say that subscriptions are going to come in a couple months. This is definitely good news overall, in my opinion, although I do think it can create a little bit of gross margin pressure in the near term. So let's say that the overall full self-driving take rate is 30%. I think introducing subscriptions might increase that to, 35, maybe 40%, just as more people are interested in the overall product. But then the take rate on upfront purchases is likely to decrease. So rather than Tesla getting all that cash flow and all that those earnings up front with the product sale, instead they'll be recognizing it month to month on at least some portion of those. So depending on how that math shakes up, it could actually create a little bit of downward gross margin pressure in the short term, but in the long term, it's definitely going to be a good thing for Tesla and for its financial results. Another surprise to me was just that the beta program has over 1,000 users. That was a huge surprise. I kind of thought that it was closer to 100 users. So that's just good to know that there's that much more data going back to the FSD team, a lot more cases that they can be reviewing and improving quickly. And then they did reiterate that autonomy is capable with the current hardware suite. So good news there, not a surprise, but kind of good to hear some of these questions that are material to the autonomy robotaxi business case continue to be answered with good results. As Elon noted in the beginning of the call, autonomy and robotaxis, that is to some extent priced into Tesla at the current valuation. So it's just good to have these continuous checks that, yeah, there's no major flaws here in the hardware suite or in the expected rollout of the program to additional users. The last thing I wanted to touch on was around DOJO. DOJO is the supercomputer that Tesla is developing to assist in labeling the data that they get from their full self-driving fleet. This is a tool that will really improve the rate at which full self-driving itself is improving. We've known about DOJO for a long time, but the interesting thing to me here is how they commented on how the Vision AI software that Tesla is developing and the DOJO supercomputer that is also under development can really be applied to other business lines in the future. So this is another kind of unknown upside potential for the stock. I mean, what other industries could vision learning and really the outstanding AI that Tesla has developed here be deployed to solve other problems? Definitely could be used in a lot of areas outside of just automotive, but it's very hard to quantify what they are. So I'd be curious to hear your views in the comments. What do you think DOJO could do in the future? How big of an opportunity do you think this is? And what are some of the practical applications that both vision-based AI and the DOJO supercomputer could help to improve in the future? So that wraps it up for today. If this is valuable to you, please consider supporting Spark Spread on Patreon. Hit like and subscribe, pass it to a friend. But most of all, thank you so much for watching. I'm Matt Smith, and this is Spark Spread.